Welcome back, everyone. My name's Adam. Rusmin.
Hello.
Victor.
Hi, everyone.
Thanks for joining us. We're all in black today.
Yeah.
All right. And today we're going to talk about Singapore banks. And the reason why we're doing this is because all three banks have released their fiscal annual results recently. So OCBC was the last one, and it just came out this morning.
Correct.
So we wanted to do this fresh off the press and update you what's happening with the banks, because a lot of interest with Singapore banks.
Yep.
A lot of people like their dividends. We like their dividends as well. So we want to share with you what's up with the banks, the latest results, and what the outlook is going to be like. So why don't you just tell us a bit more about all three banks?
So I got the table over here. So let's talk about their full year result. So the full year result, DBS total income, which is their revenue, up by 10%. OCBC is up by 7%. UOB is up by 3%. So the DBS is still the best performance, right? And I think we can expect that because they are the nation bank. They have the lowest cost funding as compared to the other two banks. So in terms of profit, DBS still outperform the rest at 11.2 billion, and which is about up 12%. OCBC is about 8%, and UOB was 6%. And if you talk about the latest 4-quarter year-to-year performance, right, I think OCBC didn't do as well as the other two banks, which you can see why their share price tanked at this point of time when we're recording, okay? Because they missed the estimates. Because if you look at DBS, they are up 11%, UOB is up 9%, but OCBC is up 4%. Okay, so I went in to read into the the press release and the document. I realized that it's because first margin compression, right? So both not only OCBC, the other DBS, UOB, they also affected on the net interest margin, slower growth because of the interest rate. But if you look at DBS, operating expense only increased by 9%. But their revenue actually increased much more. UOB decreased 2% in terms of operating expense. But OCBC, their operating expense increased by 19%. Okay, so that is one of the major costs because they have higher staff costs. They also raise their headcount and also add in some compensation into it, an increment, right? So that caused the drop in terms of the fourth quarter and missed their estimates, which a lot of I think analysts don't like, normal market don't like. That's why the other two banks are up, but OCBC are down right now.
Okay, so basically all three banks still seem to be doing pretty well. I mean, on a year-to-year basis, it's good. But the fourth quarter for OCBC wasn't so good. And they just didn't do as well as the other two banks.
Correct.
But is there any reason, did they share, I mean, you mentioned staff costs and headcount. Is there any reason why OCBC's, why did the management say anything about why the cost went up so much? 19% is a lot.
Like I mentioned, they mentioned it's because of they hire more people, they raise headcount, and also I think they acquired a bank and integration, so that the cost all went up for that. So let's talk back to their net interest income, which is the main thing. So we need to talk about the net interest income and net non-interest income. So I think it's expected for this whole year, as in not the last whole full year of 2024, that the net interest income will actually slow down. Okay, so you can see from here, right, for the full year result, DBS net interest income still grow by 5%, right? OCBC is 1% only, and UOB is 0%. It's very common because the interest rate peak and there's some rate cuts and all this. But what comes in very strong for this 2024 full year is that the non-interest income is the one that carries the whole profits and everything, right? So you can see that the non-interest income for DBS actually went up by 23%. OCBC is 22%, whereas the UOB is the much less, is 9%. Right? Yeah, because I think UOB, they got a lot of integration and all this when they bought over the city and the Taiwan and all this, right? But good news is when the interest was cut, their loan growth came back. So you look at their loan growth for this full year 2024, right? For DBS was 3%, OCBC was up 8%, so UOB was up 5%. But if you compare back to 2023, right? 2023, right? The loan growth for the DBS, UOB, and OCBC range between 0 to 2%. Only OCBC loan growth is 2%. The rest, DBS and UOB, loan growth is 0% growth.
So people are borrowing more because
lower interest rate.
So I think it's like it works both ways. I mean, interest rates go up, banks can make a higher spread, but then fewer people are going to borrow. And then the other way around, they get more loans.
Correct.
Lower spread, but still it kind of balances out.
Yeah, so it's sort of like offset and keep the net interest income, keep some growth to the net interest income.
Okay.
Yeah.
And then of course, if they have more loans now, and if interest rates rise in the future, then this current loans
price
are
are higher.
higher.
Yeah, but they're not expecting that, right?
Yeah,
The outlook of the bank is, if you read the transcript and all this, most of the banks, they are expecting a 2 cut.
Okay.
And I think most people are expecting a 2 cut in this coming 2025.
Okay.
Right. So they don't expect a big jump even when they increase the interest rate.
Okay.
But the DBS, the CEO got mentioned that based on the 2 cut, it will affect their net interest income between sub 100, between 50 to 100 million for them.
Okay.
Yeah. For the other two, OCBC transcript I have not read yet because it's not out yet. UOB, they didn't mention much about that, but they feel that they can maintain the net interest margin.
Okay.
But the good news is the CASA ratio is coming back.
Mm-hmm.
CASA ratio is your current account and saving account, which is the low cost funding for the banks. So all these are coming back already. People are funneling the low cost funding. So with the low cost funding coming back, right, and they maintaining the top, and plus the 3 banks are talking about cost management also. So if you look in terms of DBS, right, they did talk about cost cutting, reducing staff, and they recently announced they're going to cut 4,000.
I saw that article. That
over
was
the next 3 years.
that's a huge number.
Yeah.
Yes.
And they're going to replace by AI.
Yeah.
Okay,
It's
so all
another
these
one, yeah.
cost maintaining, right, will maintain their net interest income. UOB also talk about cost cutting, right, in the transcript. OCBC, I have not read the transcript, but in their press release, they talk about managing the cost already.
Okay.
Okay, so I think the AI will help them to reduce in terms of the number of employee, which will become more efficient in their costs, plus the CASA ratio is coming up. So I think they are able to maintain the net interest margin.
Okay.
It will be flattish, but it will be maintained. Okay, but the only thing interesting is that during the outlook, when they talk about the outlook, right, DBS is the only one that got mentioned that they expect that 2025, the net profit to be below 2024 level due to global minimum tax of 15%. So maybe the profit growth may not be there for this coming year for DBS. So you have to take note about it.
Okay.
Yeah.
So even the US is a bit messy right now.
Yep.
If you've been following news.
Correct.
So so even despite the uncertainty in the US, with potential inflation coming back, they still kind of have the outlook that interest rates are going to cut at least twice this year. That's the outlook. I mean, we don't know if it's going to happen.
That's the. I think most people, if you read previously, they thought going to cut more, but because of this inflation, they reduced to 2.
Okay.
But the banks got say these things are ever changing one. Right now they can tell you this, but maybe the next Fed meeting is going to be different. So you never know. Right?
Yeah.
But it's only based on the current situation.
Yeah.
Because it's very fluid.
It's like more than fluid, man. If you see what's happening with Trump in the White House and everything is going on in government, it's like you don't know what the US is going to do next.
Correct.
That sort of uncertainty is uncomfortable.
Yep.
And interest rates could go up. I think I read some news recently that the US could just they just refuse to pay back loans for for Chinese lenders. There's some news article on that, and if that actually happened, then of course the reputation of the US as a lender is going to go down, and also the interest rates will go up. So of course you don't know if these things will actually happen. There's so much stuff going on, but you see, this will all affect the banks because interest rates are so sensitive to interest rates.
Yeah. So I think the key thing is to really see whether the banks can survive the next crisis. Do they have buffer or not?
Okay.
So if you look back at their CET1 ratio, right? Okay. There's a table over here, their CET1 ratio. So the 3 banks after the full phrase CET1 ratio. That means after Basel IV already. Okay, because now they are on the transition. So I show you the full phrase one. So the DBS we're going to be 15.1%, OCBC is going to be 15.3%, UOB is going to be 15.4%. Okay, so this 3, right, 15+%, right, is actually a very good buffer compared to a lot of the global banks.
Okay.
Right. So I think our Singapore banks, first, the MAS is, in terms of calculation, they are much more conservative. And because of if you have followed through our articles on the bank's AGM, you have gone through our video, you know what the reason why they are returning capital right now, because of the Basel IV. Right? Basel IV relaxed the rule because Singapore banks have been so strict. That's why they now got excess capital after the Basel IV. Okay, transition. So that's why all of them, they're going to, especially OCBC and UOB, they did mention they're going to maintain a 14% CET1 ratio, which they think is enough. Then any excess capital they're going to return, which they're going to return in the next few years, which I'm going to talk about it later. Yeah.
Okay. So that will come through the form of special dividends?
Yes, capital return,
Okay.
special dividends and all this.
Okay.
Right.
So I think for income investors who basically love the banks, that's good news.
Yeah.
Yeah.
Correct. But we also need to note that all this capital return that they're going to give you, the special return, right, is not permanent.
Yes.
Okay.
It's a one-off thing, right?
Because every bank, they did mention at the back part is that is subjected to market condition and regulatory approval. Okay. So yes, it's now. But if suddenly the stock market crash, right, the economy go into global crisis, they may not pay. Okay. They already put that disclaimer down there, subjected. Right, to market.
Well, that's the thing about investing. You never know.
Correct.
There's no 100%.
Yeah.
You just have to like place your bets according to your risk.
Correct.
And what makes sense.
Yeah. So right now, I feel that a lot of investors now, when they invest into the banks right now, they are looking with the regular dividend plus all this special. You're going to have a very high yield, right? But if you are a very conservative investor, then you want to look at what's the current regular dividends that is sustainable over the current share price.
Okay.
Right.
So let's look at the valuations then.
Yeah. Okay. So let's talk about the dividends first. Okay.
Yeah.
So the good thing about the dividends is that DBS, right, they are really committed to return capital. So you can see their dividend actually increased by 27%. Okay. OCBC only increased 4%. It was quite shocking because they cut the dividends on the second half. I was expect 88 cents regular dividends, but they make it 85 cents, but they give a special dividends. Okay, UOB is 180, only grow by 6%. So the lowest growth for dividends for this year, right, for this full year 2024 is actually OCBC. Okay, but let's talk about capital return. So DBS announced about 3 billion buybacks and plus the 2 billion, right? According to the earning call transcript, right, it's about 5 billion. Right, and previously they announced a 3 billion share buyback. So in total, their capital returns, according to the CEO in the transcript, right, is 8 billion. Okay, for the next few years. And OCBC, right, announced 2.5 billion, and they're going to give you the special dividends starting from this full year 2024. The rest of the bank is next year you get it.
Okay.
I mean this 2025. Sorry.
Yeah.
Okay. UOB is 2.8 billion. So among capital allocation, UOB fare the lowest, right, which is about 2.5 billion. I do hope they can give back more, but they just gave 2.5 billion.
Okay.
I think that's also part of the reason why the share price is tanked today. Also.
Okay. And DBS seems to be the most popular recently among investors because I think for this reason as well.
Correct.
Yeah.
So they're going to give back 60 cents, 15 cents per quarter for this whole year. And the CEO did mention that they're going to for this whole year, but they can sustain for the next 2 years. Okay, but can be payback or they can do share buyback also. Okay, but on top of that, right, the CEO did mention in the transcript that now they got this 3 billion share buyback, right, but they still got bullet to do another 3 billion share buyback if necessary.
Okay.
So that means they still got extra 3 billion, not 8 billion, but possible 11 billion of capital return. Right. So that is also the reason why DBS is traded at premium right now.
Okay. I mean, so someone watching this is like, it looks like the banks can give back more capital in the future, possibly. So we mentioned what are the yields of the three banks now?
Okay, so just based on the regular dividend, excluding the special, we need to be very, very conservative right now, right? DBS is about 4.76%.
Okay.
OCBC is about 4.91%, and UOB is about 4.66%.
At the time of recording.
At the time of recording. Okay, so they are rather close to 5% mark in this way you were to see, right? Okay, I mean OCBC is the highest right now, right? Because their share price tanked, I think about 2% when I look at them just now, right? But if you compare them to the 10 years SGS, right, it's about 2.82%. It still makes sense to own the bank as compared to owning the SGS bonds. Why? It's again, we need to, like Warren Buffett said, you have to compare with the bonds, right? Now the risk-free bonds is 2.82. This one is much higher. It makes more sense to still be on owning the banks, right? In terms of opportunity cost and risk. Okay, it's just that a lot of people ask, can we still go into the bank right now?
Yeah.
Like I said, there's still opportunity to go into the bank right now because it makes more sense to invest in the banks than the bond. Okay, but we must not go in with a investor mindset. I feel we must go in more of like a short-term trader mindset, but with a exit in mind. Okay, because like for me, I bought my OCBC at $9.03, right? So at my price, right, if any economic crisis were to happen, it may not drop down to this price. Right? It will still be above. But if you have bought this price, it may drop below your this price, or it may go higher and drop below, or maybe it will break even. Okay, because the risk reward ratio is not there already. Okay, it's still there, but it's just lower as compared to the time where I bought it. Okay, but it still makes sense to invest in the bank. So, but you need, when you buy, right, you need to make sure that you have an exit in mind. You must look at the valuation of the bank. Okay, the moment the yield drop close to the SGS, it makes more sense to switch out of the bank, and also look at the bank's PEB. Okay, because right now we all can agree that high inflation is likely to stay, which means that interest rate is likely to stay high, not low anymore. Okay, so I think a lot of the banks, they are expecting about 3% moving forward. So doing this kind of normalized 3%, is the banks will do quite well for this just by managing costs and returning capitals.
So my father-in-law also bought during the COVID, right? 2020, he got in a very good price. Every last few years, he has been asking me, should I sell OCBC at $12? Should I sell OCBC at $13, $15? I told him to wait. Now OCBC at $17 plus. So he asked me again, should he sell, right? I said you could do a partial divestment if you want to, right? Because I look at the price to book, right? All the three banks, right? I think we do have this chart. It seems like to me it's really on the high side, but from your perspective, it doesn't seem like it's it's the time to sell, right? Because of the if we compare with the Singapore saving bond, I think Singapore banks still have a higher yield, right?
Yeah. So because if you were to see during especially high interest rate environment or normalized interest rate environment, right, the bank's book value tends to price at a much higher price to book because their book is worth something, right? Moving forward, right? So if you go back to history, right, doing like normalized interest or higher interest rate, right, the bank's price to book tend to trade at, during good times, 2 times and above.
2 times?
Yes, correct. Yeah, and that is usually also flag a signal that is slightly more expensive on the high side. Okay. But if you only look at the 3 banks, right, only one bank hit 2 times. Just hit only, which is your DBS. Right? But your OCBC and UOB is slightly around 1.5 and below. Right? So if you were to, based on that theory, right, actually the OCBC and UOB tend to have much higher in terms of upside in terms of price to book. Right? But of course, it also, why DBS is traded so high is because their capital allocation that they are giving back. Right? So that's why investors like them, because they are really giving back capital to the shareholder. So I think there's still possible room, firstly on the PB side, and second is the yield still makes sense to own the bank.
So for PB charts, I think this one, what you're seeing is actually live, right? But next month or a few months down the road, the PB chart may be updated because bank valuation may have changed. So I think you will want to have a handy access to this data live, and we actually provide this data on the Dividend Machine platform for all our Dividend Machine member, which is still open for registration right now, and we're going to close this by the end of this Sunday.
This Sunday,
right? So this PB charts, I think we will update it once a month, at least to give you an idea whether the banks are on the expensive side or on the cheaper side.
I'll update first week of the month
for the 3 Singapore banks. Right?
3 Singapore banks.
Each bank, not the group.
So you get to see the charts of each Singapore bank, the historical range, and whether it's above or below its average. So every month they will update that.
And on top of that, for now banks, I think the valuation seems to be on the higher side. In terms of yield, it's still quite attractive, right? And I always warn our members, right? I mean, you don't want to just invest purely based on banks, right? Because bank is also very sensitive to interest rate, just like REITs. And the best way to take good care of your bank investment is to actually hedge it against the REITs, because REITs prices tend to not do well during the high rate environment, and bank prices tend not to do well when the rate actually starts to drop,
and then vice versa,
right? So you want to, in the case, let's say there's a big rate cut tomorrow for whatever reason, right? You were mentioning that US is so uncertain right now, right? And rates suddenly drop, right? And obviously bank prices might get hurt, okay, because there might be a margin compression and stuff like that, right? So by hedging your position on REITs, REITs prices tend to benefit when the lower rate environment, the cost of funding is going to be a lot cheaper, right? And right now it's actually a very good time for you guys to actually look at REITs, because the valuations are all-time low due to the higher rate environment, okay? And it's also one of the best time for you to pick high quality REITs, and then you want to really accumulate up, right? So for us, it's now we are just doing, building out that REIT investment, and then obviously you need to know how to pick the right REITs, right?
So just take note that if you were to get into the bank for the position, it should be a small position. It should not be big. Because the risk reward is not there. You only go big position when your risk reward is very high.
And that, I know if you have the data, then you can make that decision.
Correct. And do go in with, if you go in with a small position, you must have an exit price in mind. And this exit price will shift according to the bank's announcement on a quarterly basis. Okay, so you have to take note about it.
So just a reminder, not a recognition to buy or sell anything during the banks. This is just our opinion. But of course, if you want to know more about Dividend Machines, do check out dividendmachines.com. It's open until the 2nd of March, this Sunday. After that, it's going to close for this year. And then we're going to talk about it next year. So if you want to get in now, do go to dividendmachines.com, and then we're going to basically provide the price to book charts for the Singapore banks
and also the REITs
as well.
And we're also going to talk about how you can actually manage your portfolio, all right, and then build your allocation for REITs, for banks, and also for the other dividend stock if you're actually planning to build passive income for your retirement.
All right, just to confirm, we only have the price to book charts for the banks, right?
And the REITs also.
All right, so we have the charts for the Singapore REITs as a whole, Malaysian REITs as a whole. So we can kind of tell how the industry is doing.
And whether they are currently cheap or expensive, right? So right now, if you look at the chart, right, I mean, you can just log into the Dividend Machine once you sign up, right? And you can actually look at the chart, and you know that it's actually a cheap time to accumulate REITs, quality REITs.
All right. So is there anything else that you've learned from the results over the three banks?
I think the bank will still do well in this coming year. Just maybe a slightly flattish or growing a bit, but you will never know, because we didn't expect the non-interest income to beef up, but last year they beef up a lot, as in the growth a lot on the non-interest income. So that was a additional shock to investor, right? So this year, I think it feels like it's just going to be a flattish year, or maybe just low single digit growth. But if the non-interest income start to, which you look at the past history, they tend to do well on this kind of situations, then it may be a extra surprise for us, but no promise, we don't know. We're just guessing on it.
Okay, so I think for those who are watching this, it sounds like sometimes banks are quite like a easy investment, just buy it for the yield. Actually, the way you do it, you actually take in a lot of consideration of what's going to happen with the macro events and the results. And you don't just buy based on the yield. You want to have a look at the valuation based on the PB as well. And then, like you said, you want to have an exit and entry in mind. I mean, it's very different from a more passive investor who's just like, oh, the yield is good.
I think banks are semi-cyclic in nature.
Semi-cyclical,
if you want to get full
like benefit
optimization of investing in the bank, right? You should buy it when it's,
you gotta follow the cycle.
When it's at almost peak the cycle, you won't get the best price, but you almost there, right? And you exit and you wait for the next cycle come. I did it. This is my second time doing it. The first cycle was in the 2000 and before 2016. Right? The bank crashed. So you buy within 2018 was peak. We sold, right? So that went up about 50, 60, 70%. Then I'm just repeating the cycle right now.
Okay. So there's actually a cycle that you can follow. If you're familiar with enough, it's quite a good thing to.
But of course you are someone who like to be passive and you don't want to do. And you want to hold it long term, that price must be a good price that you buy.
Your entry price.
Like my entry price for OCBC was a good price. If I want to be passive, I can be passive.
You can buy and forget and enjoy a high yield.
So it really depends on your style of investing. But I think for Singapore banks, it's something that you can actually track and follow. It's just three banks, right? But then if you want to learn how to do this, do check out dividendmachines.com. We actually teach you how to do that within the course itself, so that you can basically ride the cycle, know when the best entry and exit is for the Singapore banks. All right, so do check out dividendmachines.com if you're interested. Anything else you want to share about the banks or the results today?
Nothing. Bank won't be affected by any disruption or this.
Hopefully not, right?
Money grow money, right? Money grow money.
Not. If something happens to the banks, we're dead.
And somehow with the Basel IV, they become even more asset-like.
Okay. All right. So that's pretty much it, right, guys?
Yep.
Yeah.
All right. So if you have any questions about the banks and the most recent results for all three banks, put them in the comment section. We can answer your questions. And if you like this roundtable, please hit the like button. Of course, check out dividendmachines.com if you're interested to learn how to invest for passive income, for dividends. It's only open till this Sunday, and then it's going to close.
Yep.
All right. So with that, my name is Adam, Rusman, Victor.
Thank you.
Thank you so much, especially for going through all the results and reading the transcripts and everything, so that you guys can learn what's up, and then we just basically give it all to you within this last 15-20 minutes. And with that, we'll see you around, and goodbye.